Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi, everyone, and welcome back, or welcome to the Physician's Guide to Financial Wellness. This is Andrew Mushbaugh, and I'm joined, as always, by my co-host, Trent DeBruin. And today we're going to talk about 5 common investment mistakes, which awareness of potential mistakes is always step number 1. But we'll take it a step further and also discuss some of the things you can do to avoid some of these common mistakes.
All right, so what's the over-under for number of CNBC jokes this episode?
Oh boy, are we that predictable with bad jokes?
No, they're just too easy of a target when talking about investing.
Well, I guess we already hit 1, right?
All right, we'll set the number at 2 then.
I like it. I know we'll do our best. So the 5 common investment mistakes we'll discuss today are 1, waiting for the quote-unquote right time to invest. 2, anticipatory selling, which is basically the inverse of the first mistake. 3, buying into or buying more of the latest hot stock or investment trend. Number 4, over-concentrating in one stock or in one area of the investment universe. And number 5, chasing income, yield, or really anything along those similar lines. And before we dive into the 5 common investment mistakes, it's helpful to zoom out and see what all these investment mistakes have in common, which is an element of our human behavior and emotions. So we'll discuss the mistakes themselves throughout, but also focus on the underlying behavior or emotion that is really driving us to make these mistakes. So with that in mind, Trent, why don't you start us off with the first mistake of waiting for the right time to invest?
Sure. So when looking at this first investment mistake, it's centered on the idea of inertia or not taking action, which, as a side note, this is one of the few situations where you'll hear us say that not taking action is actually a bad thing. What this looks like in practice varies by person and situation, but for the purposes of this conversation, we'll discuss this mistake in the context of someone who has cash on the sidelines that could and should be invested for a future goal, such as retirement in 10, 20, or 30 years, but who is reluctant to actually go ahead and invest it. This cash on the sidelines could be from a large bonus through work, an inheritance, or simply cash that's accumulated in the bank over time. Now, we're certainly proponents of always keeping some cash on hand, like a checking account for day-to-day living expenses, an emergency fund, or money earmarked for a larger expense within the next year or two. But beyond that, there comes a point where you're losing money, at least in terms of your money keeping up with the rising cost of living, i.e. inflation, by having too much sitting in cash. Once you realize you have too much cash on hand, reaching the conclusion that you should be doing something better with it is the easy part. The harder part, and where this first mistake comes into play, is what to do with it. Do you use it to pay down debt, or should you invest it? And if you invest it, what should you invest it in? Well, this decision of what to do with the excess cash can be difficult. By outlining your priorities and preferences, it becomes easier to decide what makes the most sense for your situation, i.e. pay down debt, invest, or some combination of the two. The hardest part, and the place where the most mistakes are made, comes once you've decided the best course of action is to invest, regardless of what you're investing in. This is where our hardwiring as human beings becomes a detriment to realizing a successful long-term investment outcome. Specifically, this is where fear tends to kick in, and we immediately think, well, what if I invest this money today and my investments decline by 10, 20, or 30%? And this feeling tends to become stronger as the dollar amounts involved become larger. Sitting in cash is easy. Its value doesn't fluctuate, and you don't realize your money is actually losing its purchasing power over time as a result of inflation. However, with investing, especially investing in the stock market, there's the reality that you could invest money on day one and immediately see the value of your money decline by 3% or more, at least on paper, the very next day. We've referenced this in the past, but as humans, we tend to dislike losses about twice as much as we enjoy gains. In other words, if someone said you could flip a coin, and if you win, you'd get paid $100, but if you lose, you'd have to pay $50, most people wouldn't take that deal, even though the odds are clearly in your favor, and if you were able to repeat that bet enough times, you'd be guaranteed to come out ahead. So as you can see, due to this loss aversion that's inherent to human nature, we're predisposed to having a bad investment temperament, and this fear of losing money is only amplified by the headlines and concerns that are exaggerated by the media. Because of this fear, investors will often make the mistake of trying to wait for the quote-unquote right time to invest. For example, I'll just wait for the market to go down 10%, then I'll do it. Or I'll just wait for XYZ economic indicator to come out, or wait till we're past the election, or wait till a certain geopolitical issue is resolved, as if there's a magic bell that will ring when the coast is clear and it's the perfect time to invest. Unfortunately, this typically results in you missing out on investment returns because the stock market goes up more often than it goes down. And even beyond that, the stock market is an extremely efficient and forward-looking discounting mechanism, where by the time you get the all clear that a certain risk has passed, that good news will already be reflected in the market in the form of it having gone up. This dynamic can also further compound the timing mistake, because if you didn't like investing when the market was 10% lower, how much harder will it be to now go ahead and invest when the stock market is 10% higher, for example? As you can probably see, this often results in a negative cycle of poor investment decisions, hindsight bias, and then even more fear about investing in the future. So that's the mistake to be aware of, but what should you do about it? Well, step one is to set aside your emotions to the extent you can, and any opinions about whether or not this is the right time to invest, since no one can predict that. From there, you're left to decide what the best path forward is for you when it comes to investing the money. This could be investing it all at once, which from a purely financial perspective is the optimal approach over time, knowing the market goes up more often than it goes down, or investing it on a set schedule over a predetermined period of time, like doing it in 1/3 increments over each of the next 3 months. We won't dive into the details of these two approaches, lump sum versus dollar cost averaging, since we have an entire episode devoted to the topic, episode number 48. But the punchline is that the antidote to waiting for the right time to invest is deciding on a plan on the front end, whether it's investing the cash all at once or spreading out your investments over the course of several months, and then sticking to that plan and executing it in a disciplined and unemotional way.
So do you think our ancestors who are running away from tigers would favor a lump sum or a dollar cost averaging approach?
I think they'd be happy with either option as long as they didn't have to run from tigers anymore.
It's a good point. I guess we should be grateful for where our stress and fear comes from today.
Hey, I'm with you. The stakes are definitely lower, and I'd take a 3% stock market decline over a tiger any day.
Yeah, me too. Which that actually leads us to the next mistake, which we'll refer to as the anticipatory selling, or from our ancestors' perspective, what we can do to avoid running into that tiger again in the future.
You're really getting some mileage from this tiger theme, huh?
I think it ends here.
All right, good.
So our second mistake, anticipatory selling, is really the inverse of mistake number one. Instead of making the mistake of not taking action, you make the mistake of taking action, which I know we sound like a broken record, but when it comes to investing, there's a time to take action and a time to be patient and sit tight. So what we're referring to here is basically the opposite end of the spectrum, at least in terms of what's required to realize a successful investment outcome. Anticipatory selling is, as the name implies, selling in anticipation of something. It's less important as to what that something is, and more important to understand the universal emotions and behavior that lead up to the action of selling. In other words, when the market is down 25%, it doesn't matter if you're selling because you think the market will go down 50%, or you're selling because you think aliens will invade tomorrow and you want to be prepared. The mistake is that you are taking action, selling, in anticipation of an unknown future event. So that's the mistake, but it's important to understand what drives the mistake, which again is our emotions, and specifically fear. Similar to not wanting to invest cash on the sidelines because of the unknown future, this mistake is the opposite, where you want to get out ahead before something bad, or worse, happens in the unknown future. There are a million different ways people rationalize or interpret what this unknown future event could be, but the universal emotion or feeling is the value of my investments is falling, and I don't want to lose even more money, so if I get out now, at least I'll have certainty that it can't get worse. Sound familiar? No, of course not. All of our listeners are immune from the ebbs and flows of the stock market, but we'll pretend for a second this might be relevant for some of our listeners and continue with what happens with this mistake of anticipatory selling. Well, by selling, you take what was previously just a loss on paper and turn it into a real loss, at least if you keep the money in cash, which I'll take a quick second to explain the difference between a paper loss and a real loss. If you bought an investment for $10 and it's now worth $8, a paper loss means that you are down $2. In other words, you're temporarily down $2, but what if the investment goes up to $11 the next day? Well, then you would have a paper gain of $1. Whereas with a real loss, if you bought that same investment for $10 and now it's worth $8, but instead of waiting until the next day, you sold the investment and received $8 in cash. Well, by doing that, you turn what was just a paper loss into a real loss of $2. So with anticipatory selling, you convert paper losses into real losses without providing the opportunity for the value of the investment to recover. And this is most common during a stock market decline. If you think back to March 2020, during the early stages of COVID, where the stock market dropped by 35% in less than 2 months, well, if you sold when the market was down 25%, yes, you may have prevented a further decline of 10% over the next 2 weeks, but you also locked in a 25% loss. And if you never reinvested the money, you would have missed out on the subsequent 70% plus recovery of the stock market. In other words, the main issue with anticipatory selling is that you convert paper losses into real losses and are then left having to fight the emotions involved with deciding when to buy back into the market, cue the vicious cycle of now going back to the first mistake that Trent discussed of waiting for the right time to invest. So what can you do to avoid this?
People are going to be disappointed with the answer, aren't they?
Yes, thanks for softening the blow there, Trent. What you should do is nothing. But joking aside, the idea is that you should stay in your seat, at least assuming you have a well-diversified investment portfolio that was designed around meeting your unique goals, and wait for the temporary stock market decline to pass. Which, if you'd like a deeper dive in this concept of what you can do during stock market declines, apart from the overarching guidance of sitting tight, we have an entire podcast episode dedicated to the topic for those who are in retirement, episode number 53, Managing Your Retirement Paycheck During Stock Market Declines.
Yeah, we know some of these solutions seem overly simple, but the challenge isn't in the concept, it's in the implementation of the concept. Remember, simple doesn't mean easy, especially when you're fighting an uphill battle against our inherent human nature and emotions. Now, so far we discussed two common mistakes that are driven predominantly by fear, but shifting gears a bit, the next mistake we'll discuss focuses on the opposite side of the coin, which is greed. And mistake number 3 is buying into or buying more of the latest hot stock or investment trend. It probably doesn't come as a surprise, but as humans, we have a tendency to compare ourselves to one another. And this theme applies in many areas of life, including investing. If you ask someone whether they'd be happy with a C+ grade, most people would probably say no. However, if you told them that C+ meant that they had the highest score in their class at Harvard, they'd suddenly feel better about it. Objectively, a C+ is still a C+, but knowing that you did better than everyone else has a tendency to make things feel better. Translating this to investing, if you were told that your investments were up 25% during the year, you'd probably be happy. However, if you then learned that everyone else was up 75%, your feelings would change. At that point, you'd probably be thinking, why was everyone else up so much more than me? Rather than being happy that you just earned an annual return more than double the historical market average. This dynamic is best summarized by Teddy Roosevelt's quote that comparison is the thief of joy. So mistake number 3 involves buying into or buying more of the latest hot stock, investment trend, or particular area of the stock market that's been doing the best lately. And we discussed this in terms of the stock market, but it really dates back through the course of human history, from the tulip mania of the 1400s to the gold rush of the 1800s to the dot-com bubble of the early 2000s. All of these examples center on a universal theme, which is everyone else is getting rich quicker than me and I don't want to miss out. Or as millennials have famously coined, FOMO, the fear of missing out. Now, it's important to step back and recognize there's nothing inherently wrong with wanting to do well and take advantage of what might be a good opportunity. The problem is when you get greedy and try to chase the latest shiny object or get-rich-quick idea by investing in XYZ stock or investment trend. Trees don't grow to the sky, and most often if something sounds too good to be true, it is. Yes, there are people who purchase lottery tickets that win hundreds of millions of dollars, but think about the 99.99999% of people who lose all of their money trying to be part of that infinitely small minority. With investing, yes, some people have made a lot of money by investing in Apple or Amazon early on, buying Bitcoin when it was worth a penny, or being an early mover in other successful investments or trends. But the mistake we're referring to here is that most people join the party late, only after the best returns have already been realized. This is further exacerbated by the media, which tends to discuss and hype various investments only after they've been noteworthy performers. So odds are by the time the general public hears about something, it's too late to actually act on it. A common phrase you'll hear when it comes to investing is that past performance is no guarantee of future performance, and over time there tends to be a mean reversion dynamic where the best performers in the most recent period tend to be the relative underperformers in the subsequent period. Going back to our earlier example, you may be sitting there with a 25% return and feel the FOMO that you aren't earning 75% on your money. So you figure there may be some reason to switch gears and join in with the latest trend or fad. This is where the mistake happens. You buy into an investment at an all-time high where the returns moving forward then revert back to the norm, and typically even lower than whatever investment you sold to chase the hot trend. Or worse, you end up chasing a bubble, like a tulip mania of the 1400s, that then collapses. There will always be a temptation or new shiny object to chase, but more often than not, just like buying a lottery ticket, you'll end up losing money by getting greedy and making reactive adjustments in an attempt to get rich quick. So what should people do to avoid this?
People aren't going to like the answer to this, are they?
Thanks for returning the favor of softening the blow.
I had to do it.
The answer is to not be greedy. So avoid comparing to others, avoid the temptation to chase what's been hot lately, and stay disciplined by maintaining a strong foundation and context that's based on the evidence of what works in investing over time, not what's working best or has been working best at a given time. Also, it's helpful to keep in mind what investment return you need to earn to accomplish your financial goals. If, for example, you only need a 7% annual return to reach your retirement goal, that will help avoid the temptation of chasing an investment that's been earning a 20% annual return in recent years. Big picture, this is really the main benchmark we encourage people to use when evaluating their investment returns. What is needed to reach my financial goals, not my friends, neighbors, colleagues, etc. Essentially, the goal with mistake number 3 is to avoid buying high, which typically leads to mistake number 2 of anticipatory selling at a lower price, and ends up at mistake number 1, where you're then left deciding when to invest the money from the investments you sold.
Yeah, it's pretty easy to see how all these mistakes compound.
For sure. It can get ugly in a hurry, so we're trying to help everyone avoid that vicious cycle.
Well, on that note, the next mistake we'll talk about is very similar to mistake number 3, but can also come about gradually over time, especially for those within certain industries or who work at companies that offer stock options. And the mistake is having your investments overly concentrated in a particular stock or sector of the market. And this follows a similar theme as Trent just outlined, where you have to fight the temptation to get greedy or extrapolate what has done well recently in the hopes that you have a smaller scale version of winning a lottery ticket. This has been especially relevant over the last decade, from 2010 to 2020, with many of the large tech companies, Amazon, Facebook, Tesla, Apple, etc., which came after a period from 2000 to 2010, when this was the lost decade for US stocks, as the market had a 0% return that was caused in large part by the tech bubble bursting in the early 2000s. I'll skip the longer stock market history lesson, but what's important is the point to draw from this, which is that there are long periods of time where an investment, country, or sector of the stock market can do really well or really poorly. So with mistake number 4, especially after a really strong period, there are certain investments that may have grown to become a large portion of your overall net worth, which was and can be a good thing when the investment is performing well and you're earning above average returns, thus growing your overall net worth at a faster clip. But when the shoe is on the other foot, especially if you have 20, 30, or 40% or more of your net worth tied up in a single stock, you can quickly see that paper gain you accumulated disappear. Think back to Enron, for example. And while it's intuitive to know that having one stock or industry make up 50% or more of your net worth comes with risk, it's not uncommon for people to discount the risk when one investment makes up 20%, 25%, or 30% of their net worth. In many cases, there's almost always a sense of loyalty where you feel like you can't sell the stock because it has done so well, or even a sense of FOMO that if you sell the stock, it will inevitably continue to go up. And on the flip side, even when things are going poorly and the stock is headed the wrong direction, there can still be a feeling that it will come back and a tendency to hold on to an underperforming investment for a long period of time, to the extent that it ends up lowering your long-term investment return. Regardless of how it happens, the big mistake here is being overly concentrated in one stock or industry where it can have a material impact on whether or not you can meet your financial goals. Again, think back to those Enron employees who had 90% plus of their retirement tied up in one company, and as a result, can no longer retire. In a nutshell, that's the outcome you want to avoid. And while being overly concentrated can sometimes turn out well, that quote-unquote best case scenario is not what we care about, since in that scenario, you would have likely been able to reach your goals anywhere. It's the worst case scenario where you put yourself at unnecessary risk. So in order to avoid this mistake, the answer is again likely intuitive, but it's to diversify your investments and spread out your overall net worth. If the stock you love is up a lot, whatever that means in your book, that's a good thing. It means you were able to lock in a gain and capture a benefit from being in that stock. If it continues to go up after you sell it, you may feel a sense of regret, but you'll still most likely own some of that stock in a smaller scale way by remaining diversified. Conversely, if the stock goes down after you sell it, you will have saved yourself from a potentially devastating impact to your overall net worth due to the concentration. In other words, the goal is to follow the famous investment quote of, avoid owning enough of any one stock that you can make a killing on it or be killed by it.
Exactly. And we recognize it's a lot less fun to talk about how you prudently trimmed your exposure to XYZ stock to ensure proper portfolio diversification than it is to talk about how much money you made on it.
We must not be going to the same dinner parties. Everyone loves talking about some good investment diversification.
Oh, I think I might be going to the wrong ones.
Yeah, I think I actually am.
So the last mistake we'll talk about continues with the theme of chasing, although in this instance, it's centered on our preference as humans for certainty and clarity. When it comes to investing, this preference translates to our desire for something tangible or guaranteed, especially for anyone who's nearing or in retirement. This is exemplified by the strong emotional appeal of an investment product that offers a guaranteed 5% return over something that fluctuates over time, such as the stock market, but has historically provided an average annual return more than twice as high. We refer to this mistake as chasing income or yield, which is an umbrella term for anything that offers some amount of promised income. In other words, an investment or product that, regardless of what's happening in the world, offers to provide you with a certain return or dollar amount of money each year. As I mentioned, this can come in many different forms, such as investing in stocks that pay high dividends, high-yield bonds, also known as junk bonds, certain real estate investment trusts or REITs, or in a more tangible way, the appeal of rental real estate where you own a property and have a tenant paying you money each month. We don't want to discount the benefits of income or yield since this is an important component of your overall investment return, but the mistake happens when you exclusively or predominantly chase yield without regard to your total return. Said differently, it's quite common for someone to get lost by comparing investments exclusively based on yield or dividend, such as comparing a junk bond that offers a 9% yield to a high-quality investment-grade bond that offers a 5% yield. Why wouldn't you take the investment that offers the much higher 9% return? Well, if the only variable that mattered was yield, we would agree. If it's a true apples-to-apples comparison, take the investment with a higher yield, but that almost never matches up with reality, and there are other factors to consider. Taking a step back, it's helpful to ask why an investment is offering a 9% yield when other investments are offering a 5% yield. In the case of high-yield bonds, the answer is risk. The reason you're offered a 9% return on your money is because there's higher risk that you won't end up receiving your money back in the future if the company goes out of business. One of the core principles of investing is risk and reward, where if you want the potential for a higher reward, return, you'll have to take on more risk. So with investing, you don't want to focus exclusively on the yield or income of an investment, but instead want to look at the total return, which takes into account all the components that make up your investment return, both interest or dividends you receive and expected market appreciation, i.e. the price of the investment increasing over time. Chasing yield or investing solely in high dividend stocks typically produces a more risky and less diversified investment portfolio and a worse long-term investment outcome. The best way to avoid this mistake is to always focus on the total return of an investment and your portfolio and find a balance you're comfortable with. For example, interest tends to make up a much larger percentage of the total return of bonds, which is why they're viewed as less risky than stocks. Whereas with stocks, much of your total return comes from market appreciation over time, and that portion of your expected return tends to be pretty volatile from year to year. So when we refer to finding the right balance, it's the idea of matching your risk tolerance with the total return you need to meet your goals.
Exactly. That's the most common theme on our podcast, finding the right balance for you. Well, that's everything we wanted to cover today, and hopefully it was helpful to walk through some of the most common investment mistakes and what you can do to avoid them. And Trent, we did it.
You did what?
Avoided making another CNBC joke.
Yeah, well, this has to count as half a CNBC joke.
All right, fair point, but that's still better than another bad one.
I guess that's true.
All right, so to give a quick recap, the first mistake we discussed is waiting for the right time to invest when you have cash on the sidelines that should be put to better use. And this is one of the few times where inaction is actually a bad decision and is effectively another form of market timing based on the fear of investing your money only to see it go down. While the financially optimal approach would be to invest any excess cash on hand all at once, a way to help ease this fear is by dollar cost averaging, or investing a set amount of money over a set number of months to quote-unquote ease your cash into the market. The second mistake is really the inverse of waiting for the right time to invest, which we refer to as anticipatory selling. Anticipatory selling is another form of market timing based on the fear that if you don't do something, i.e. sell XYZ stock, or worse, all of your investments, then you'll eventually lose even more money by this inaction. And this typically results in you selling at an inopportune time, turning paper losses into real losses. To combat this, the punchline is to do nothing, which we joked isn't the most helpful advice, but it really is the best advice in terms of staying in your seat and letting the investments ride their course and eventually recover back to new all-time highs, at least assuming you have a well-diversified, low-cost portfolio. The third mistake relates to chasing the latest hot stock or trend, which deals with the opposite emotion when it comes to investing, greed. And the mistake here is really around comparison. You compare your investment return to what else is out there, and if it's lower, you have this feeling of FOMO, or fear of missing out. However, this typically results in you investing or buying at a high point, which negatively impacts your expected future return. In order to combat this, it's another short answer that's easy to understand, but harder to implement, which is to avoid comparison, remain disciplined, and avoid the temptation or thought that you need to always be chasing the highest possible return every single year. What matters is your return over time, not at any given time, and that your return over time is enough to meet your goals. The fourth mistake is similar to the third mistake and often happens over time, where you end up having too much exposure or over-concentration to one particular stock or area of the stock market. This has been especially common over the past decade, where many people have ended up with far too much exposure to one stock, like a large tech company they work for, or one area of the market, like large US growth stocks. The problem here isn't when the times are good, but when the times are bad. If one stock makes up 50% of your portfolio and helped grow your net worth to XYZ value, it's important to remember that can just as easily go the other way and have an equally negative drop that could prove detrimental to your long-term investment outcome and ability to meet your goals. So the way to combat this is to periodically review your concentration in any one particular stock or area of the market and do your best to remain well diversified to spread out your risk or exposure. And lastly, the fifth mistake is chasing income or yield. This is related to the idea of wanting certainty in the form of a guaranteed return. Unfortunately, this mistake often results in people missing the forest for the trees. In other words, they may take on more risk than they should in order to earn a higher yield or income stream, or simply have lower long-term investment returns because they didn't focus enough on the total return of their investments, i.e. the other factor of market appreciation. So the key to avoiding this mistake is to always look at your total return, which is the combination of your income and dividends and the market appreciation of your investments. Well, thanks everyone for joining us for another episode of the show. You can find the show notes at the podcast page of our website, mdwmllc.com/podcast. And if you have any thoughts to share or questions you'd like to have answered, please feel free to shoot us an email at info@mdwmllc.com. Take care, everyone, and we'll look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight from Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.